From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last day of March 2023. Checking the calendar, Monday is a holiday, or at least it should be. It's the Brewers' home opener. The Bucks have a couple of home games this week. The 76ers are in town on Sunday, and the Bulls drive up I-94 for a Wednesday night game. And remember, when spelling Wednesday, the D is silent, just like the reaction to my jokes. The first rule of buying online is be sure you're dealing with a reputable seller. Well, here's what happens when you don't. A guy bought what he thought was a pit bull puppy. His first clue that something was way wrong, the animal didn't even look like a dog. So he took some photos and showed it to his vet. From the pictures, it was determined it wasn't a dog at all, but a hyena. The only person laughing now is the seller. A man in Chicago who put Nazi swastikas in the window of his apartment said he put them up to get attention for his missing fiancée. Who's his fiancée, Eva Braun? Now, if you don't know that reference, ask your parents. An Egyptian fisherman was facing 4,760 years in a Greek prison. His crime? Smuggling 500 people into Greece aboard his very crowded boat. Well, he got caught, and then he caught a break. He got a judge who's soft on crime and reduced his sentence from 4,760 years to just 280 years. Well, that seems much more manageable. And finally, an Indiana police officer recently visited a South Vermillion high school to teach the students about careers in law enforcement. But he wound up accidentally shooting one of the teens. The kid's going to be all right, but that's probably not very good for recruiting. On the podcast today, we have Kendall Bauer, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. What a week it was, and not just a week, but the quarter. The NASDAQ up 3.4% this week, closing at the bell at 12,222. S&P 500 up 3.5%, closing at 4109. And the Dow Jones Industrial Average adding 414 points on Friday, up 1,036 for the week. That's 3.2% to close at 33,273 for the year. The Dow Jones Industrial Average now up 0.9%, including dividends, just north of positive again. The S&P up 7.5%, including dividends, and the NASDAQ a stellar 17%. Maybe a quick look at returns. Of course, Kendall, I think if you look at the first quarter in context here, we're talking about an S&P that's up 7.5%. Certainly, growth stocks doing far, far better. Maybe NASDAQ one representation of that, but better than 10 or 11% on growth stocks broadly. And yet, when you go back to, the start of this quarter, it was a really strong start, up the first month or so. February, a month that was a lot of down, and then a lot of back and forth in March. It feels like there were as many bad days as there were good to start the year. I think a lot of investors will be surprised to learn when they get those March statements just how strong things really are. And I think, maybe speaks a little bit to the psychology of investing in general.
Yeah, Kyle, there's, interestingly enough, a term in behavioral finance known as myopic loss aversion. Briefly, it's the combination of a greater sensitivity investors have to losses than to gains, and a tendency to evaluate those outcomes more frequently. Basically, the more you look at your portfolio on a regular basis, the worse you're going to feel about performance. And subsequently, on the opposite end, the less you look, the more you're going to see gains over a longer period of time. I think the downside of checking your accounts on such a regular basis is it can lead you to make more emotional decisions about rebalancing or feel like you have the need to maybe mess around or make small tweaks more than you might need to. And we know that letting emotion drive your investment decisions is never a good idea.
Kendall, how much of that is an individual thing? How do you work with clients that sometimes you tell them to look more often or less often?
I think it's less about the frequency of reviews. Typically, we try, I would say on average, to talk with clients twice a year is a pretty good routine. But it's more of some of the conversation that comes up, Joel, where clients throughout this first quarter have said, hey, I look at any given day that we're having a review and, my account's down. And then we get into the meat and potatoes of maybe performance the first couple of months of the year. And, more often than not, someone in a balanced portfolio is actually surprised at, the positive returns year to date.
I think I'd even add that when when we're reviewing accounts on a regular basis, whether it's every 6 months, every 3 months, you kind of have to remind people that we're looking at a very small time frame of data and performance relative to what our overall investment philosophy is. We're long-term investors, just generally speaking, and I say, if we're looking at and we care more about how, let's just say as an example, if we're looking at the validity of an investment and how good it's performed, you're not going to say, you're not going to pick investments based on, the last 3 months have been fantastic, let's buy that. You're kind of going to look at the average annual returns over the last maybe 3, 5, 10-year periods of time. So I just kind of go through an exercise of trying to remind people of, while this stuff is very important with how we position ourselves, it isn't everything. We have to keep our mind focused on maybe not where things have gone or been, but what do we expect more in a longer term context? What's the narrative over the the next 3 to 5 years? And I kind of compare that to generally portfolio managers that we invest in have generally a 3 to 5 year timeline for those investments to realize the returns that they're expecting or hoping for. And if they don't do it, usually they'll cut ties with the particular stock.
And of course, the reminder that we always get served anytime we're looking at performance, and that is that past performance not indicative of what we expect going forward. I think this quarter a great example of that very principle, right, Tom? That we look back to last year and it was the value stocks that had led the way, but led the way in what was a pretty rough market overall. Not a lot of positive things to hang your hat on, and all of a sudden this year it's the growth stocks that seem to have come back pretty sharply. Potentially a reminder that you can't just look at last week, last quarter, last year's performance and go, here's where I want to be.
Yeah, I think when it initially started happening in the beginning of this year with growth stocks leading the way and continuing to lead the way, a bit of a head scratcher, and kind of digging through the data and reading more on the subject, you kind of have to believe that I kind of relate or use the analogy of water kind of drifts to the lowest place, and just a reference to money's always going to look for the best value. And so when we have such a long period of time of leadership and growth in technology stocks from 2009 to 2021, and then all of a sudden, as Bob would say, growth stocks think like rocks, it happens, people still holding on and reminiscing about that very prosperous time in that arena are now seeing those as values. So I believe my belief right now is that the gravitation of markets towards growth is a lot of times to capture some of those high, those more volatile, more aggressive names that now are seen as a discount, and we're seeing that capture leadership again. But it's important to know that it may not be, again, we have to kind of compare with the context of where we see the environment going to be over the next longer period of time, 3 to 5 years or so, to know whether or not that these movements that we see in the first 3 months are lasting. Are they going to stay? And so that's just important to, kind of going back to rules and principles that you don't want to completely abandon value to now chase growth because you're just going to be chasing your tail in a circle. And so it's always more about, in my discussions, about diversification and balance and just, being humble enough to know that what we don't know and to have our hand in anything, because the environment right now, as we're constantly seeing with the volatility and market speculation, is constantly changing.
Well, and I think it's clear, Tom, that the market has so strictly focused on single issue, right? That single issue being, what's the Fed going to do with interest rates? And we often forget that stock prices are really driven by two things. Day-to-day could be anything, but long-term, really the only two things that matter are earnings and interest rates. And the earnings piece has largely been disappointing. And if you look at stocks, in particular growth stocks, and go, what's the opportunity set? The earnings aren't that attractive. They're attractive, but you got to look out more than just the next few quarters to really get the benefit there. But it's the interest rate piece now that's really driven the conversation, as the Fed has kind of taken their foot off the gas of higher interest rates, as we seem to have settled into some expectations for where things are headed. It makes the math for growth stocks a little easier, which is, I think, what's allowed them to rally as much as they have. But you're right, there is some kind of reminder built into that we can have all the confidence in the world that rates are going to stabilize. We can have all the confidence in the world that that's a good thing for growth stocks. but there's so many things that can come along to prove just how wrong we are that it isn't enough to just say, well, the best opportunity is growth, and so that's the only opportunity we're going to take. I think it's a reminder, if anything, that the opportunity set is broader than just the growth versus value conversation. And it's more about good businesses versus bad businesses, businesses with a lot of debt versus businesses that maybe have done a better job of managing their balance sheets, aren't carrying the kind of debt that would be an issue in the current interest rate environment. And so, as I look at, how do we choose to navigate the current environment, the bigger issue for me is not strictly, okay, our interest rate's going to be higher or lower, and what does that mean for growth versus value? But maybe we need to be a little more focused on the quality of the businesses, the quality of the funds and the businesses they're buying, than strictly just the conversation on growth and value.
Yeah, I think historically bear markets bring about new leadership. And so, and me, I guess if, when I tell my clients, if I have any biases, one of mine is just that things tend to work in cycles. You look at historical heat maps of either asset classes or sectors over time, you kind of, when they're nicely color-coded, I will add, your eye kind of is drawn to some of the patterns you may notice. And, so if we've gone through such a period of time where growth has led the way and certain, more aggressive risk-on type of asset classes do better, then my bias might be to say that, well, maybe in the future it's not growth and technology that leads the way. And we look at an environment with potentially higher interest rates, higher valuation, higher PE multiple type of companies are going to be largely more compressed and have a harder time, seeing their prices go a lot higher, or let's say investors being willing to bid up or pay more of a premium for those companies in a higher interest rate world because they're just not valued as much. It's the discounting mechanism of higher interest rates, and so you have to be mindful that there could be other sectors out there, and you look at some broader investment themes, whether it's again a higher interest rate world. Talking about deglobalization, infrastructure spending bills, things that might favor other sectors ahead. And so I think those are some of the longer-term investment themes that I think play more into the types of investing we do in general anyways.
And of course, at a time when now the S&P 500 is maybe fairly valued or a little overvalued from a price-to-earnings perspective, the earnings piece now comes into that conversation. One of the reasons why, despite the fact that the S&P is still down 14% from its peak, one of the reasons why it still looks a little fairly or overvalued is that, well, the earnings piece has come down pretty substantially. And so, Joel, we can talk about kind of the economic piece of this in just a second, but know that, the next couple of quarters of earnings growth really don't look all that attractive. It's part of the reason why when you're looking at the price of the S&P relative to future earnings, maybe there's a little more challenge to that math than there has been in a while. We throw around the earnings recession piece. I think corporate America is showing more signs of recession than the economy at large is. And there's, I think, some pretty significant reasons for that we've talked about on the podcast in the past. But, I think it's important to point out that the forecast still is for some reacceleration of growth and earnings later this year. And as we look at, Joel, some of the economic data, we got a GDP number for fourth quarter, final revision that looks more or less like the economy was doing okay at the end of the year.
It was, Kyle, but one of the things that we found, because that was the third revision of the GDP for the fourth quarter, and it started off with the consumer spending part of the GDP, which is, drives 66%, 70% of the economy. So in the first numbers on the GDP, they had consumer spending growing at a 2.1% annual rate. The second revision, it was growing at a 1.4% annual rate. And now the final version was that it was growing at a 1% annual rate. So just recapping there, it's going down. So consumer spending is going down, and it's slowing down, and that's going to be slowing down the economy. We got numbers today on consumer spending and consumer income, and that showed again that consumer spending is going down. When you correct it for inflation, consumer spending has gone down 3 out of the last 4 months. So that's telling me that maybe some of the things that the Fed is doing to raise interest rates to try to slow down the economy, that maybe it's taking hold a little bit, that consumers are taking a hint from that.
And, buried in that spending data that came out was the personal consumption expenditure index number, which is pretty closely watched by, I think, just about everyone now as we look at, kind of the Fed's measures of inflation and what it means. Well, PCE, that personal consumption expenditure index, is a pretty important one to follow. More signs that, we're back to the right direction for inflation, even if the number isn't where we're hoping it's going to get.
That's right. And that's what the Fed is aiming for, right? I mean, that's sort of the main measure that the Fed is using to see that its policies are working. And it was 5% year-to-year inflation rate from February of last year. That's down from when it was 7% in June, and that was a 40-year high. That 5% is the lowest that we've had since September of 2021. But again, a reminder that the Fed's long-range target for that number is 2%. So 5% down from, 7% this summer sounds like a pretty good move, but it's still way above that 2% mark.
And then this week we got kind of two different measures of how the consumer feels about the economy. It's rare, at least in my memory, that these two tell a somewhat different story. It seems like this week there was a little bit of a clash of information here, some differing expectations on inflation, maybe a different magnitude of sense of where the economy is headed, but data both on consumer sentiment and consumer confidence.
Yeah, and the big difference there was the inflation expectations. In one survey, consumers were saying, in the next year they expected inflation to be 3.6%. So that's, lower than that 5% we're talking about. The other survey, the consumers interviewed said that they expected to be 6.3% in that same time. So go figure that. But both of them actually were showing that more consumers are considering that the economy is going to slow down enough that it's going to go in recession. The one survey from the consumer from the conference board, they have a level there of expectations for the economy, and that's been under the kind of recession warning sign for 12 out of the last 13 months. So there's that. And then the other consumer sentiment survey came out from the University of Michigan today, and that also was showing signs that consumers are being more careful. And so, again, with those numbers that we saw that consumer spending is slowing, we're also seeing that consumer savings is starting to go up. So that's another sign that maybe people are being more careful.
As they should be, of course. You can only overspend your earnings for so long, and the challenge with higher savings rates, of course, is that it's spending that's not happening today. But also remember that it's more spending that potentially can happen tomorrow. And so if consumers feel a little worse about the current state of the economy, they may save a little more now and spend a little more later. That becomes the self-fulfilling prophecy, right? This vicious cycle that ultimately ends in some kind of recession. I think I'm always interested in some data points that show we're doing that a little bit. I'm more interested when we start to string a lot of those together, and we really aren't there yet. There's been, I think, a lot of back and forth on a lot of this sentiment data, a lot of this confidence data, signs that certainly the expectations are for things to be a little slower than they have been, but also that, broadly speaking, the economy is stable, if not as strong as it used to be. The other thing we got, which maybe we haven't released or talked much about recently, is some of the housing data on home sales as well as housing prices. And I think, Joel, perhaps a sign that the housing market is showing similar signs to what we just talked about.
Yeah, mixed results, but mostly showing that things are getting slower. The Case-Shiller home price index showed a year-over-year increase in prices of 3.8%. That's the lowest it's been since I think March of 2022. It's been a long time anyway. It's been going down. No, I'm sorry. It was at 20.8% in 10 months ago, and it's been decelerating every month since then. That was in March of 2022.
So I think overall, more signs of what we've been talking about, an economy that continues to soften a bit, but that for the most part is on solid footing. You add in what was an incredibly strong start to the year, and I think investors should be excited to get their statements sometime next week and excited to kind of look at the performance numbers and see a bigger number maybe than what they've seen in a little while. A reminder, that what Kendall was talking about earlier about, it doesn't always feel the way it really is because you place greater emphasis on the down days than the up. But we had some pretty strong up days in that first quarter, and so I think pretty happy with where we are at the moment. As always, we enjoy doing the program for you, and we look forward to talking to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.